Buddy, today is July 5th, 2022. It is Tuesday, just a little bit afternoon here in New York. I hope everybody had a great 4th of July. I know some of you are still on vacation. A lot of pros are, out still today. I think a lot of people are going to be coming back tomorrow. Interesting though, speaking of July 4th and fireworks, look at the market today. We are seeing a little bit of a sell-off in equities. The big story today really is all about the dollar. Dollar's just on a rampage. It's up 1.41% today. Mostly it started with the euro. It happened really early in the morning today. We saw the euro selling off, causing the dollar to go up. At first, it looked like most of the gains in the dollar was from the euro coming down, but then most other currency pairs started showing that, including the Australian dollar, which has implications for our plays. We'll go over that soon. But, the big story right now is the dollar. The dollar is up. Euro, right now Europe is in a rough spot. Their energy prices have skyrocketed to the point where now there are real fears about them being able to produce and export. Their export machine is really Germany. Germany is the country that the Eurozone counts on for exports, and so that export machine has propped up the euro above the dollar above parity. All right, but now that a lot of German companies are not operating because of the costs of staying open with energy costs the way they are, now there's fears that maybe those exports aren't going to happen in the near term, and so is pushing the euro down. So that's what we're seeing right now on the macro front. When will that get resolved? It's hard to tell. Nobody knows for sure when it's going to be going to be resolved. All I know is that this is what how the market is reacting to it. Okay, let's actually take a look at the euro. So yeah, early in the morning, we saw the euro just sell off, sell off, and then that's what caused the dollar to go up. And again, the Australian dollar also is breaking down as well too. All right, we're seeing that break down, and that is tailwind for our FXI puts. Our FXI puts are actually doing very well. Our put spreads, our November put spreads, are actually in the profit now. We're still at a slight loss for the August, just the August naked debit puts that we have. The dollar rising is also pushing our EEM down as well too. Our puts are in decent profit right now. I still think there's a lot more room for EEM to fall. Speaking of EEM, just a couple of days ago, I know some of us talked about potentially buying puts on the European ETF, equities ETF. Man, should we have done that? Oh my goodness. That would have been a crazy payoff. So not only Europe, but all the other European ETFs like Italy, Spain. I remember just a few days ago we were talking about potentially, buying puts on these Greece. Right now look at the percentage fall in Greece, 6.33 for Greece. Europe down about 4.8%, so it's definitely the weakest. I think that China will follow, especially with the Australian dollar doing what it's doing. Remember, I said the Australian dollar is the lie detector test. And remember, here we had news that Shanghai was reopening, and it caused FXI to go up, and as well as the Australian dollar. But then when it broke down, I said, hey, I'm calling BS on that move. I don't think it's right. I think somebody knows something that perhaps the reopening is not going as well as planned. And behold, last night at around midnight our time, a news report came out on CNBC saying that there is a huge spike in COVID right now in China. They're dealing with another wave, actually. They just signaled that they were reopening, and all of a sudden, in different parts of China, they're starting to see more spikes of COVID. So there you go. Somebody knew something, and it showed up in the currency markets first. Again, usually your currency traders at institutional desks are your smartest people in the room. And obviously they saw something in order to short this. Now, this is not doing very good for our metals play. Our metals play was a hedge against the dollar coming down, because the dollar going up was a very central thesis for our EEM and our FXI shorts, or our long puts on EEM and FXI. So we did have a small gold position. Let's look at the gold futures. So just a little bit of management here. If it closes under this 1783.4, which is very likely, it looks like it, but if it closes under last session's low, I am getting out of this. I don't blame you for wanting to get out of it now if you're in this. Again, I told you guys to keep this really small. Again, I'm still about 95% in cash. If you combine all my positions, it's about only 5% of my spec account. So these positions are all very small. I'm willing to take the loss and just move on. It was a hedge for my bigger plays that were in FXI and in EEM. Out of that 5%, I would say 2/3 of it was EEM and FXI. So this was a small bit just to hedge, just in case if the dollar dropped. I don't think we're going to get that. I don't think the dollar's going to drop at all. It may just keep going up, especially with the euro in free fall. But right here, if it can't go above 1783.4 and close above that, I will just get out of my gold spreads. Right now, for gold, I think my gold spreads I got in because I legged in at different times. Again, I only have a few spreads. My cost basis was around 3. Right now, it looks like it's around 250. So it's just a small loss. It's like 50 cents. So about 16-17% on those spreads, which isn't much on a small position. It is what it is. We'll see what happens at the end of the day. If it can get above there, I'll keep it for one more day. If not, well, we'll just exit. That's life. That's trading. Okay? So we'll move on from there. That's gold. So let's take a look at some of the U.S. indices. E-mini, S&P 500. We're at 3771. We're down about 1.43% today. Let's see. NASDAQ is not as down. Is it mostly in? Yeah, it's mostly in the industrials. So, mostly in the industrial names. Let's see sector-wise. I wonder which sectors are doing the worst. Oh, wow. So your metal miners, yeah. So energy, metal miners, those are your worst performers today. So it's only it's only natural that your Dow Industrial is going to have the hardest time. But yeah, with the Australian dollar doing what it's doing, again, the Australian dollar is also a good indicator of what metals are going to do, just because they're a big metals exporter. Toasty mentioned in the Discord this morning that there's a very good chance with the dollar going up like this that oil may break the 100 psychological zone, which happened. If you actually, it just happened literally right after he said that. Within like an hour or two, it happened. So, that's what happens when the dollar goes up. A lot of commodities denominated in dollars goes down. So we're seeing oil breaking down. And again, I kept telling everybody, the low risk to reward trade is to wait for that 119, 120 zone and short there. Some people were talking about going long around here in different oil names. Oof, I hope you guys kept that small. And again, I kept saying that if you go long here, what if it drops? And lo and behold, that's what happened. So I'm not saying that I saw that happening. I didn't see something like this happening. But again, that's why risk management is so important, and you want to pick your battles and pick your shots at the best places so that you get the least amount in drawdowns. Okay, so that's oil. Let's just take a look and see what's happening in gasoline. Gasoline's also down as well too. Natural gas also down as well. So most commodities are down. Let's look at corn. Oof. Wow, not giving us a chance. Totally not giving us a chance. We were going to short here. That's not going to happen. It doesn't look like it's going to happen. Okay. It's already breaking down too much. I don't think it's going to retrace all the way up to here until next season, at least. Oh, well. We weren't able to capitalize on that. I know a lot of you were long on corn and things like that. Hopefully you all were able to get out when I told you all that this was probably the top in grains. Let's see what's happening in wheat. Wheat also just getting demolished. Soy also taking a beating. So all commodities across the board are really taking a beating here. Also uranium also having a really bad day. Again, dollars going up, which is usually not a good sign for most commodities. And the Australian dollar breaking down this much is usually not good for metals. Not good for China either. So our FXI is doing quite well though. UVXY also back up. Our spreads, our call spreads are doing pretty well. I may buy more. Because VVIX is so low, it's actually not bad to actually leg into some more of these calls. I may not leg in the same ones just because of the skew. The skew for some of these has come down. See, it's narrowed. The skew is narrowed. It was a way more difference between the 15 and the 20. I might go 15.25. So I would still be keeping the same long strike, but getting a little bit further out on my short strike. I may leg into these a little bit more. I think there's a lot more volatility ahead of us. And I might leg more into this. I haven't made up my mind yet, but I will, I might. I don't think it's too late to still keep legging into EEM. But right now, chasing it right now, I mean, just getting more right now seems like chasing. I wish I had more. I kept everything super small. I'm not sure. I kept everything really, really small. We will see. We will see. I still have this FXI as well, Just want to show you guys, what that I still have these positions. I haven't gotten out yet. GLD, I still in that position, haven't gotten out. Again, that's 1780. What was it? The previous low session. Yeah, right here, 1783.4. If it closes below that for today, which looks like it's going to, I'm just going to get out. If it starts getting to the low of the day, I might just get out too. So that's not that much. If it drops just a little bit more, just a few more points, I might just get out. And just be done with it. Take a small loss and move on. But I think it's going to be payday for our FXI puts. Okay? So that's what I'm seeing right now. Everything across the board is in the red. I just want to see small caps. Small caps also not doing very well. Man, though, a few days ago when we talked about those Europe puts, should have got them then. We were talking about it around here. And I said, oh, well, maybe if it goes up a little bit more, I'll buy puts. Shouldn't have waited. And that seems to be the theme in this market. When you buy puts, get aggressive. That seems to be the theme here, okay? When buying puts, get aggressive. I don't mean get aggressive in timing. Don't do zero DTs or short-dated DTs because you never know. You might see a relief rally. But, when on the fence about longer-dated puts, just get in because market seems to want to dump every chance it gets. Again, the big picture here is the dollar. The dollar. This is the chart everybody's looking at. Okay, nothing else really matters. I think this is what really matters in the end. Nothing else really matters. It's this. This is what's important. What's going on with rates? Rates are coming down. Okay, so we're looking at some slowdown fears. As rates come down, generally, that means, people are going towards safety. Let's take a look at some of our other data points here. This is the... Oh, wow, this is the 10-year, 2-year spread. 10-year, 2-year, we're flat. Oh, no, now we're negative. We're inverted now. 10, 2-year, inverted. Bank stocks, not doing well. Okay, let's see what bank stocks are doing. Now that we're... Oops. XLF. Yeah, down 2%. Down more than the market. Again, 10 and 2. What did I say? 10-year, 2-year spread is very important for bank profitability on loan operations. Without this being steep, they're losing money big time. Okay? Let's look at the 30 and 10. Well, the 30 and 10 is increasing, so we'll see. Maybe that's just noise, but I still see it in this range. It's still in this range. It's really not giving us much. Let's see, that's the dollar. Let's take a look at what's going on here. Okay, with commodities coming down, it's only natural that we see this coming down. So it is starting to break down. Inflation fears. So now we're getting into recession obsession. We are now in that stage. Recession obsession. Okay. I still think at some point, maybe not this year, maybe not next year, but 2023, 2024, I think that this could come up again. But for now, this season, I think the peak inflation is in, or at least that's what the market is pricing in so far. We'll see. Hey, sometimes, this could all reverse, right? You never know. But right now, it looks like it's breaking down. Okay? So that's important to keep in mind. I think as commodities keep coming down, if oil keeps coming down, if oil, natural gas, all these food commodities keep coming down, and if we see oil at, I don't know, low 90s, upper 80s, We see all the grains come back to their mean reversion. I could see this coming down to around here, this zone right here, and then we'll see what happens to longer-term Treasury rates at that point. Okay, maybe we see those recession signals again, and who knows? Maybe the Fed starts loosening. That's very possible. And if they do, I bet inflation comes back in about a year or so. Again, that's what happened in the 70s. There would be inflationary fears. The Fed would tighten. After it tightens, the economy would slow down. Inflation would get less. It would start coming down. Recession obsession would take over, and then the Fed would either take their foot off the gas pedal when it comes to tightening, or they even start easing, and then inflation comes back. So that's what happened in the 70s, and that's what caused that 9-10 year cycle. It also happened in the 1910s. It seems to be a common theme. We will see if Jerome Powell gives in, or if he stays on course and he really is serious about stopping out inflation no matter what, even if it means sacrificing some short-term growth. We will see. We'll see what happens. Speaking of uranium, this is one of the uranium names I was looking at. UUUU. With Australian dollar doing what it's doing, if one were still to have this thesis of being bullish uranium, and I still think I'm still bullish on uranium. I just think our timing is off. All right. I would actually wait though a little bit. I can see the metals, just because of this Australian dollar sell-off. I can see the metals coming down to around here, maybe another 20-25% haircut or so. All right. And if that happens, definitely, all the metals are going to get affected, I think, especially with the Australian dollar coming down. Sometimes you have to pivot. You have to take what the market gives you. And if the market tells you that you may be wrong, well, you need to listen, or else, you're going to just face bigger drawdowns. I purposely kept all the positions very small because I knew, there's a very good chance of some big moves in the currency markets. But if this comes down, that's maybe when I want to get into some shares. One of the shares of uranium companies I'm looking at is this, Energy Fuels. If it comes down, I could definitely see it going into the mid threes. This is the second largest uranium producer in the United States. They're the only uranium mill operator in the United States. The other one, Cameco, it's a Canadian company, and their mill is in Canada. But there's only one uranium mill in the United States. It's in Utah, and Energy Fuels Incorporated controls it. All right, and I think with long-term, with some countries planning on increasing their nuclear energy capabilities, I think it's worthwhile to look into this. Again, it's going to only be something in my spec account. I'm not putting this into my long-term account. This is something, even if I buy shares, it'll be speculative. All right. But I'm willing to buy shares if we start coming down into the mid or high threes. That's when I'm going to leg into shares of UUU. Right now, I only have those URA lottos. I only got 2 contracts of it. That's the only fill I could get because URA leaps are just, the options market is just not that great on them. So I only was able to get 2. So I think I'm down like $30 or something overall on this trade. Whatever. I mean, it was just to get some skin in the game. So I can't really say that's a position. That's just so small it doesn't even matter. But we'll see. We'll see how it goes. But wow, what a surprising move. At first, the gold was holding up quite well, but then it just didn't. Again, that dollar going up that fast is just not very good for any commodities that's denominated in dollars. Whenever the dollar goes up, most commodities that are denominated in dollars are going to take a hit. Whenever the dollar just goes up like that, 1-2% at a time, that's a very, that's very common. I still think gold we'll see some demand later on in the year, but perhaps our timing was off, and it is what it is. So that's what I see in gold right now. Going back to bonds, we've been looking at junk bonds, advanced declines. One of our members, Mitch, was gracious enough to take some time out of his day to scrape some data off of this. So we actually have now here at Checkmate Trading 17 years worth of corporate bond trading data. And I've been playing around with the data a little bit, and I just wanted to share with you guys what I see so far. So I posted a couple of these picks. The orange line is the S&P 500 daily close. The blue line is the junk bonds advanced decline line. Okay. And as you can see here, one thing I mentioned, and some of you guys know us from previous Discords, in previous Discords back in November, December, some of us, especially Toasty and I, were warning people that this was going to be a different market going forward in 2022, that we were going to see credit and liquidity tighten. Okay, and where did that come from? Where did I get it from? At least I got it from this. All right, now at the time I did not have all this data in front of me, so I estimated. I had to estimate based on daily numbers, but around October, November or so, I noticed that there were a lot more declines than advances for many days in a row. And generally, when you see that, you see how there was a divergence, markets going up, but the advanced decline in junk bonds was coming down. Already liquidity was coming out of the bond market in anticipation of all this tightening. Bond markets tend to show signs of a slowdown first before equities. Okay, not all the time, but usually. All right, and so that's when I knew, hey, this might be the year where we see some volatility and a bear market. All right. I didn't know it was going to be this drastic of a bear market, but I did see it coming here, and this is how. All right. With corporate bonds. But now we have now we can update this on a daily basis. There's not a lot of professionals who have this. Maybe there's a handful of elite professionals that have access to something like this on a daily basis. We are now one of them. All right, we have access to this. We're going to be charting this on a daily basis, and I will post this daily or weekly based on based on what I see. But these are definitely helpful. Basically, the bear market is not over, and we're not going to see a sustained rally in equities unless this blue line turns up. All right. Actually, what I noticed too was beginning of June, I noticed that the market was actually turning up here. Remember June 9th when we had the sell-off? Well, corporate bonds, they were still declining during that time when we had that quote-unquote bear market rally in the end of May, early June. I mean, it did go up a little bit, but already at the end of May and the 1st of June, it already started sloping downwards. So it actually gave us a few sessions warning. If we had just seen this then, it actually gave us that warning here. The market's going up, but here it's coming back down. That would have been a warning right there. Also here too, some divergence. I mean, that's a very slight one. That's hard to say that we would have been. That's hard to say that that's actionable in any way. But as you can see, this can be very powerful. All right. Usually when we see liquidity come back into equities markets, we see the junk part of the bond market see liquidity first. Whenever you see that risk taking happening in the bond market, that's when you know that excess liquidity is going to get into the stock market generally. All right. So this is a lie detector for equities. Okay. You see here, even during the bear market rallies, junk bonds didn't really do much. I mean, they went up, but they did not make new highs. Okay. It made lower highs, lower lows. It still kept that trend. And as long as that trend stays in place in junk bonds and advanced declines, the bear market will continue. Okay? This will tell us if it's a bear market rally and how long it can be sustained. All right? So this is pretty important. So, Mitch, thank you. All right? This was a huge contribution. And now, again, we have 17 years worth of data. I'm going to go back and start charting all the bear markets for the past 17 years. And, you can see the differences. It's going to take me like a weekend to do that. So hopefully by beginning of next week, I'll have some charts on what happened to advanced declines back in 2007, 2008. At different years, like also 2018 when we had that quick bear market in December and in January. Also in 2020 as well, there were signs actually in junk bond markets that a sell-off was going to happen right before the COVID crash happened. And I've said this before, I don't think the COVID crash would have been so bad if those cracks hadn't already formed beforehand. But I'll show you what that means. Again, just give me about a weekend to work on that. And I'll show you the historic charts of this advanced decline line. This is going to be a great tool for us going forward, okay? And I'll try to post this as often as possible. I'll try to post this daily, but it doesn't really move on a day-to-day basis. It usually moves in multi-week trends. So we'll see. I'll keep up with it daily, and whenever I see some changes, I'll post those charts. So today, that's what I see. Today was the first day back. Again, a lot of professionals are taking the day off today. A lot of people will be back on tomorrow. As you can see, it looks like the dollar is still continuing its rampage. Yes, it is. I don't think it's going to come down. Maybe we might see a little bit of relief and then back up again. We shall see. Oh, yeah, that looks like a complete breakdown. Not sure if I want to be holding gold right now. I might just get out soon, to be honest. EEM, still on its way down. EEM has a very good chance, I think, of hitting these levels before the summer's over. 31, 32. We have 39 puts for March. I mean, that would be a huge payout. I mean, those would easily triple, easily, if it gets to here. FXI, if this, we have those 31 puts and 31.26 November spreads, right? Yes, 31.26. And the 31s. FXI, I think, by the end of the summer, could come down to around here as well. Okay? I might leg in actually more in this, even though I know it may seem like chasing, but we're still kind of at local. I mean, it's not like it's close to here or something. We're still kind of closer to where it bounced up. So I may leg into this, more into that. EEM, perhaps that seems a little bit too much like chasing for me. Yeah, that seems a little bit too much like chasing for me, though. If this were to bounce up, I'll leg in more. That's what I see so far. Dang, what a missed opportunity this was. If this bounces up to here, I'll add some puts. Maybe around 34 and a half, 34 and a half. I might. If this retraces back up, I might get into some puts. And we even saw this too. Actually, we even saw a big trader, a couple days ago. I don't know who was on the call with me. It was one of the end of day calls. Remember these? Somebody had bought these 3430s. These put spreads. And I said, ooh, somebody big is betting big against Europe. And that was like a few sessions ago. Should have piggybacked off this. I think I want to say they also bought it in Greece. Yeah, it was in Greece. It happened at the same time. It was Greece put debit spreads and the Eurozone, Euro stocks. When I saw that, I should have went in. Dang. I mean, it is what it is. That's part of life. You know, that's trading. All right. So I am thinking about legging into more with FXI puts, EEM puts, UVXY calls. All three most likely spreads, except for maybe EEM. The EEM, I might just still do the naked puts, naked debit puts here. But UVXY call spreads, FXI put spreads. I might leg into some more. We'll see. It depends on what happens at the end of day. But of course, as always, I'll let you guys know via Discord if I do that. Is that live? MSC, what are you talking about? Live data or update daily? What does that mean? Which one are you talking about? You talking about the junk bonds? Yeah, the junk bonds, that updates at the end of the day, just because the FINRA advanced decline, the advanced decline can only be calculated with the end of day numbers, because as far, as long as there's trading going on, there's going to be more advances and declines, right? So it can only be taken at the end of day. And again, some professionals that I know use this. And guess where they get that data from? They actually get it from the FINRA website, the same website we do, but they hire somebody to go in and download all this and input all of this. Actually, I talked to one of my old colleagues that I still talk to, who's still in the industry. He told me that he was going to hire an assistant to go back and input all this data for the past few years. We had Mitch just do it by computers. So I do know that professionals do look at this, but again, it's just difficult. It's just so tedious to do that a lot of people just end up not using it, but it's very powerful. And now we have it updated. We have this updated on a daily basis, and not a lot of people have this chart that can update on a daily basis, but we do. So definitely that's going to be a huge advantage for us. Yeah. So we'll use this on a daily basis. I'll post this on a daily basis. Any other questions? Anything else you guys want to look at? Oh, let's look at Bitcoins. I know a lot of you like to look at Bitcoins and trade this. Yeah, a lot of people are still on vacation. Okay, so yeah, so we're seeing. Let me also put up options data. So let's just take a look. Let's just go down the chain and let's see what's going on. This is the daily. I need my volume. Yes, there we go. Okay. So it looks like in the last 24 hours, lots of call premium bought. Okay. So we're seeing some even distribution here. This could be carryover from weekend. Now, on the weekend, there was, usually on the weekends, what I notice is that Bitcoin has a lot of call volume on the weekends or on holidays. And then when the week starts, that's when puts start seeing a lot of volume. I think that's the difference between institution and retail, and also hedging versus um, speculating. I think that's where it comes from. We will see top trades. We're seeing top trades happening in some calls. July 22, 20,000 calls. Puts. Yeah, and these are all from when before the cash markets open. So we'll see what happens in the next 24 hours. So it looks like it looks like the dailies, the volumes are already drying out. This is the weekly for later this week, a little bit higher volume. There seems to be some demand for lower strikes on the puts. We're seeing some high volumes actually on higher strikes too. So perhaps a little bit of speculation, maybe since and actually Bitcoin is up today. So maybe people think this is the bottom. I don't think so. I think if there are speculators buying calls, it must be short term. It's got to be short term call buyers. I don't think it's going to be big institutions. I think most likely it's probably going to be small block trades, if anything. I don't think I think most institutions are probably hedging right now. Just look at the VIX, look at all other risk assets. I mean, it's just not a risk on sentiment. Regular screen trade. So yeah, see regular retail, mostly in calls. Block trades though, mostly in calls too. So okay. For the current day, as you can see, most of it has been regular screen trades, which is retail. So where's all the volume in? Looks like for July. Looks like July. So call volume actually for December. So remember how we saw that skew in December? December skew was just a little bit different than everyone else's, right? Oh, it's starting to shift though. It's starting to get more and more towards puts, but we're seeing, it's not as, the smile is not as tilted to the lower strikes as some of the closer dated ones. So we're seeing some speculation, and this is just kind of reaffirming that. I think there's some speculation going on for end of the year, but we're seeing most of your volume happening for July. And they're the 2100 strike for July 8th, 2300 strikes for July 22nd, and 18,000 strikes puts for July 15th. So July 15th, July 22nd puts, but July 8th and 22nd calls. Yeah, it seems like as if there's some call buying, but that might be just short calls covering too. I don't think that is going to be the theme for the rest of the week. If I had to bet which way this is going to go, I mean, just based on looking at just all the other asset classes and risk off sentiment and currencies, I think maybe cryptos is just lagging. It's the smallest market out of all the markets that we cover. So obviously, when you're trying to manage risk, you're going to manage risk on your bigger exposures first. And most big institutions and institutional investors have bigger exposure to bonds and currencies. Okay, that's usually their biggest exposure, and then it's equities, and then maybe with a small amount that might dabble in cryptos. Okay, so I do think that if they're going to if they're going to manage positions, they're probably going to start with their bigger positions first. Maybe this follows. Okay, so that's July 15th. We're seeing nothing unusual, really. Okay, so now we're starting to see the bigger volumes. It's really July 22nd. We're starting to see a lot more. Higher strikes and lower strikes. So a lot of hedging and speculating, perhaps, going on. DVOL did go up today, so that means option prices are going up. It was 85 yesterday when I checked. Now it's at 87. So we are seeing some buying. And as you can see from the charts, mostly it was buys. Okay, these two represent buys. Most of the transactions happen on the buying side. So either short call covering, or it's call speculation and then hedging on puts. That's what we're seeing. Let's just look for end of the month. What's going to happen on the monthlies? Yeah, lots of volume here. 22nd too, lots. So we do have the CPI report coming out next week. So they might be hedging for that. They may be hedging for the end of the month with ECB and the Fed meeting. We'll see. Right now, again, I just don't think there's a good reward to risk ratio to get involved in Bitcoin. If you're going to be involved in the short term, just keep your position small, because I think it could whiplash either way. A lot of people have been saying, oh, look at these big moves. If you really think about Bitcoin, if you look at the chart, has Bitcoin really made big moves? I mean, you could say intraday it has, but really, it really hasn't done much since, we've been in the same range since the 15th, really. Yes, it's a 5 to 10% range, but with the implied volatility in the 85s and 90s, that's implying that the daily moves in Bitcoin are about 5%. Okay, I'm not, so generally there, when it comes to implied volatility, you can do something called the rule of 16. You take either like whatever the implied volatility reading is, and you could divide it by 16, and it tells you what the daily expected move is. And that's just because of the way that actually with Bitcoin, that might be a little bit different. Scratch that. Usually that works with equities and stocks because there's 250 trading days out of the year. But with Bitcoin, actually, because it's traded 24/7, we may have to actually divide by the number of days instead of the number of business trading days. I'll have to look into that, actually. So scratch that rule of 16 for Bitcoin. But generally, that rule of 16 comes from calculating expected moves based on 250 trading days. So if you take the VIX and you divide by 16, that gives you what the market is pricing in based on options prices, what the daily move is for the next 30 days. All right. I don't think that works with Bitcoin. I'm going to have to check. I have to check the methodology of them calculating DVOL. But once I do, I'll confirm that with you guys. But again, with implied volatility that high, they're pricing in anywhere from, even if it is 365 days, it's still going to be like 4 to 6% a day. So it's not out of the ordinary for it to do that based on options prices. Okay. So I still think this is just no man's land. It's just no man's land. It's chopping back and forth at this 20,000 line. All right. I think the Bitcoin market is looking for a direction here. But if I had to gamble right now, which I don't want to do, but if I were a gambling man and I wanted to put some risk into this, I would think that the short-term move is down just because of all the risk-off sentiment we see in other asset classes. But who knows? I might be wrong. I might be wrong on that. But right now the risk to reward doesn't really favor either side for a trade. If you're long and it goes down, how much drawdown are you willing to face until you're proven wrong? Same thing, if you're short here and it goes up, how much of a drawdown are you willing to take to know that you're wrong? All right. I just don't think the risk to reward is there. Okay. That's just what I see. Anything else? Anything else you guys want to see for today? Nothing has really changed. I think, being patient is the trade right now. There's just so many things coming up. We got CPI report. We got, the Fed meeting. We got the ECB meeting. I think these are all going to be big binary events where the market just breaks one way or another based on what happens to that. And trying to predict what happens after a CPI report or a big central bank meeting, I think is a fool's game. I mean, we can anticipate, but trying to actually gamble on it is probably not a good idea. All right, so that's just what I see today. I think it's just a lot of waiting and holding. I might add to my FXI puts and EEM puts, and again, gold, I'm gonna get out if we cannot close above that of that point. Actually, it looks like it's making new lows. Did it make new lows? Did it go be? Yeah, almost. Yeah, if it breaks that low, I'm getting out. And so we're close. I might just get out soon. I don't think I want to keep this. Even no matter how small it is, I don't want to waste my mental capital worrying about this. I just want to get out. It is what it is. Okay? So that's what I see. We will be back for high noon highlights again tomorrow at noon. And I'll keep the Twitch stream going on so you can see the charts that I'm looking at and the data that I'm looking at. And later today, I will update our junk bonds advanced decline line. Hopefully, we may see some signs from that. If not, we'll keep the status quo and keep our plan as is. Anybody else have any questions? Anything else they want to look at before I call it a day here? Going once? Going twice. All right, sold. Okay, guys. I'll see you guys tomorrow. I'll try to be back on later today. Maybe I give you an update on what I do in managing these positions. Hope you guys